Hey traders, so welcome back to my YouTube channel. My name is Blessed Atuhere and I'm a Forex trader and a Forex mentor. So in our previous video, we talked about what Forex is, what pairs are, major market players in this market, brokers and trading sessions. So basically we're understanding the introduction into Forex. So in today's video, we are going to focus more on pips, lot sizes, risk management, leverage, and risk to reward ratio. So after understanding the other part, now we have to come and understand how do we make money from the market and how does everything add up. So what is a pip? One thing you need to understand is that a pip is the smallest movement in the market. So I'm going to give you an example of Euro USD or anything that doesn't have a JPY in it. So when it comes to Euro USD, most of the times when the price is like 1.1000, every time the fourth decimal place moves up or down by any ticks, that is what a pip is. So for example, if the initial price was 1.1000, if it moves up by 1.10001, that means the market has moved by 1 pip. And maybe if the original price was 1.100, let me say like 3, and then it goes down by 1.1002, that means the market has gone down by 1 pip. So sometimes when you're in the market, you calculate your profits by pips. You enter and say, maybe I'm getting out after 20 pips, or I'm putting my stop loss at 10 pips. So it's like you are calculating the price. And then when it comes to JPY pairs, it's a bit confusing. It's because as for them, they are priced differently. So for you to be able to calculate pips on JPY pairs, you would have to wait for movement on the second decimal place. With Euro USD or with other pairs that don't have the JPY, the movement is calculated on the fourth decimal place. But then when it comes to JPY pairs, the movement is calculated on the second decimal place. So if the second decimal place moves by, let me say, 2 to 3 ticks, that is like 2 pips or 3 pips. If it goes down by, let me say, -2 or -3 pips, that means it has changed by those number of pips. And then lot sizes. So lot sizes kind of determine how much you're going to risk per trade. You have to understand how much am I risking on each and every trade depending on my account size. So when it comes to lot sizes, we have different types of lots. We have standard lots, we have mini lots, and we have micro lots. So when you trade with one standard, that means you are purchasing 100,000 units of that pair, or that's something that you are trading. It can be Euro USD, it can be gold. So every time you use one standard, you are purchasing 100,000 units. And then when you use a mini lot, that is 0.1. Every time you trade with a mini lot, that means you are purchasing 10,000 units of something that you are trading. And then if you're trading using a micro lot, which is 0.01, that means you are purchasing 1,000 units of whatever you are trading, whether it's gold, whether it's Euro USD. So you have to understand that your lot sizes are going to be also determined by your account size. Okay, so you can't be using a standard on just $100. You're literally going to lose all that money. Okay, let me also talk about pip values. We are attaching value to a pip. So when you are using these lot sizes, every time they move, you make a certain amount of money. For example, if you're using one lot, that one lot is priced at $10 per pip. So every time price moves up or down by 1 pip or 2 pips, you are going to get that amount of pips that price has moved and then multiply it by $10. If it moves up by 5 pips, get $10 and multiply them by 5 pips to get $50. And then if you're trading using a mini lot, which is 0.01, it's valued by $1 a pip. So if it moves up by 2 pips, you're going to get $1 times those 2 pips to make $2. So if it moves up by 20 pips and you're using a mini lot, that is $1 times 20 pips to make it $20. And then if you're using a micro lot, this is like the smallest lot size, so it's valued at $0.1 US. So every time it moves up or down by any number of pips, get that 0.1 and multiply it by the number of pips it has moved. If it has moved by 5 pips, that is 0.1 times 5 to give you $0.5. Hope that is clear about pip value. So now that we've talked about pips, lot sizes, and pip value, let's talk about leverage. Leverage is very, very key in Forex trading because it either makes you money or it makes you a lot of losses. So what is leverage? Leverage is you having the ability to control more than what you have. Like you have a very small capital or you have a very small account, but then you're able to control even more positions to make more money than you have. So for example, brokers are going to give you leverage of like 1 to 100 or 1 to 20, 1 to 50, depending on what leverage that you want. That means you are going to make a lot of money, but the way you make a lot of money is the same way you can also easily make losses. So you have to be careful when you're choosing leverage, because yes, you can make a lot of money, but then you can also lose a lot of money because, come on, something that amplifies your profits is also going to amplify your losses. So in order to trade well with good leverage, you have to understand your lot sizes, you have to know the account that you're trading with, and then you have to lower your leverage until you understand what leverage is all about. If you want to be disciplined in trading when it comes to risk management, you can have a trading plan that guides you on how much you have to risk per trade and how much you're willing to risk on a daily, because sometimes if you don't have rules that guide you, you are going to end up making a lot of mistakes. So if you are just having $100, at least you should be risking 1% of your capital on a daily, or maybe 5% of your capital if you're aggressive. So you can always have a structure where you risk maybe 5% overall drawdown, and if you're opening more than 5 positions, at least you can distribute that risk management onto each and every position you open. So you have to understand how much you're willing to risk on each and every trade and how much you're willing to risk on a daily, so that when you hit that target of risk, you get out of the market. Okay, hope that is clear about risk management. And then that is going to drive me to risk to reward ratio. What is risk to reward ratio? So when it comes to business, you can't risk to get the same exact thing. At least you have to risk 1% to make 2%. You can't risk 1% to make 1%. That is not how business works. The same applies to trading. If you have a position or if you see a setup that is giving you an entry, at least let it give you 2% depending on how much you're willing to risk. We have something we call stop losses in Forex. You risk something and then you put a stop loss at a certain amount, for example $10. If you have a trade that is going to give you a $10 loss, at least you are targeting to make $20 to $30 on that trade. So it's like you're risking 1% to make 2% of your account. Let your target be 2%, 3%, 4%, not more than 5%, because if you're unrealistic, for example, 1 to 10%, you're risking 1% to make 10%, sometimes you might not be able to get those results that you're looking for. If this video was helpful, go tap the link in my bio that is going to direct you to my Telegram channel, where I provide PDFs that have all this information that I talk about. For example, what is Forex, pips, and all that you need to know about Forex trading, the Forex basics. You are going to be able to access all that information. So tap the link in my bio and then go ahead and follow me on my other social media platform. My name is Blessed Atohere, Blessed FX. Bye.